Good day to everyone. This is Dr. Sivaraman of iknowindices.com. Hi everyone. Okay, fine. Let me display the PowerPoint presentation. Thank you, Sandra. Display the PowerPoint presentation. Asian session live market analysis on June 7th between 5 and 5:30 GMT. We will be tracking the market again using the live market code page as a simple tool for our understanding of the market. I will give the link for the same and you can open it in a browser, and I will also focus the camera over that of the live market code page. Currently Euro is trading around 1.1916 below than that of Friday close, and negative net change is 0.0049 pips. That means 49 pips negative currently, and it came down to that level of 1.1877 below that of the psychological level 1.19, and the high is the Friday close level 1.1965. So Euro has come to that of the new trading zone, and which would have triggered a lot of panicness and uncertainties in the market. But when we check with that of GBP, it is still trading around 1.4451. The low is 1.4402. The high is 1.4452. And currently GBP is trading near that of the high 1.4452. And the net change is almost 0.0000. So only Euro has dropped considerably, and that has created the bearish feel in the market, whereas GBP has not corrected that much. But both are showing negative net change as a nominal negative net change. And USDN is currently trading around 91.35, 91.37. The low is 91.00. The high is 92.12. So they made an upward stop and from that of the Friday close, and then a downward stop, and they are holding closer to the low. The net change is 56 pips negative. So you find Euro, GBP as well as USDN have shown or showing negative net change. As a result, you find Euro Yen and GBP Yen are also showing negative net change. Then another pair which has also undergone this massive drop is Australian dollar, even though gold is holding it very firm. So what sort of understanding we can have out of that? Probably the player should explain. Then 0.8159, 0.8162 or the current level in the case of Australian dollar. 0.8098 is the low, below that is the psychological level 0.81. Already Australian dollar visited 0.80 area, and so it is not something new, and or new level. The high is 0.8226. The negative net change is 72 pips. So when Euro and GBP are shown, or even USDN are shown lesser negative net change, Australian dollar, after dropping about 200 pips, again showing a negative net change of about 73 pips. So what they are trying to do with this? We will review it after analyzing the other currencies. CHF 1.1639, 1.1642 are the current levels, and the low is 1.1618, the high is 1.1672, the net change is 20 pips positive. So when Euro has dropped about 45 pips, USD CHF has gained only about 23 pips. As a result, you find Euro CHF has come to a newer low level 1.38 area. So similar to that Euro CHF has come down drastically, and now currently it is trading negative 25 pips net change. So we find that Euro and its crosses are being affected, but rest of the currencies are normal conditions, but in the normal range, but still the bearishness or the bearish feel is being circulated among that of the traders by holding it at slightly lower level from that of the Friday close. Then in the case of Canadian dollar, 1.0621, 1.0625 are the current levels. 1.0599 is the low, 1.0677 is the high, and CH Canadian dollar is trading near that of the low, and you find its negative net change is 5 pips. So when Australian dollar is showing a negative net change, Canadian dollar as a denominator currency is also showing negative net change, which indicates clearly or confirms clearly the players are now handling the cross by making a contrarian move that Euro and GBP negative as well USD negative, and CHF has gained nominally when compared to that of Euro drop. Then we come across that Australian dollar is negative net, showing negative net change, and Canadian dollar is also showing negative net change. So basically, the players are positioning themselves across and they are expecting the higher level long holders to liquidate the long positions here. And if they don't liquidate the long positions at the newer low level, and they will try to show still lower level and induce them to liquidate the long before making the rise. So how exactly they determine that? There are two categories. One, the traders who are taken during the rise, the buy positions without any trading plan or without any hedging or the stop. If they continue to hold, then the drop will create the fear. And such emotional traders, when the drop create fear, they liquidate the long and turn short in order to earn back the lost money. So when that short selling becomes more at the lower level, then the players are not fools to drop it further down, and they may ask somebody to make a statement or deny the reports, then subsequently gain the levels. So this is how they, depending upon the traders' pending positions, they try to act against that of the traders, a large number of traders. And there could be a pocket of traders or a set of traders. They could be benefited out of the market move, and they will be doing a sensible trade of buy after the drop and sell after the rise. So, whereas many of the emotional traders, they try to buy after the rise and sell after the drop. When the drop has become visible, then if you try to sell, how much of profit you will be able to earn out of that? When the long-term calls are given that 1.17 or 1.15 or 1.12 could be seen in Euro, are they going to hold the trade for such a long time? So these are all the questions one has to ask for himself to understand what sort of trading plan he has got and how exactly he is going to avoid the risk or to minimize the risk. And these are very important strategies besides understanding the market. Now let me go to that of the PowerPoint presentation and explain what is expected in today's market. So expected move for this session. As well as today, during the Japanese session, high level swing and slide could be seen, so they could go closer to the low towards close of Japanese session. Then European session, there could be a drop, and if this drop cuts the low and go more than 30 pips, then the firming up move will be very nominal. And if the drop is less than 30 pips below that of the low, then the firming up will be very significant and they could cut the high and go above that of the high during the late European session. And in case if they don't go above that of the high, then they could do the lower level swings during the start of the US session and then gain the levels during the day. And you may not come across much of a sell-off during that of the US session today. And big beginning false move could be seen. So the false move could be on the downside as a continuation of the sentiment in order to induce the traders to sell on rally. So probably they will gain about 30-40 pips and induce the traders to sell by making a quick dip, and the traders will fall prey simply by taking a sell position. The similar tactics they have done it on the higher side when Euro was around 1.58 and 1.60. They have been holding it for a long time, and everybody thought that Euro can rise it up to 1.75, and then subsequently they dropped. And after the drop, the traders were trying to do the average because they had already the higher level buy position. And finally, they started yelling at me and started liquidating the long and turn short. And probably they might be able to see some profit. And when they see some profit, they could increase their exposure by taking more and more shorts and try to see that they will be able to recover all the losses. And suddenly you could see that when traders turn, predominant of the traders turn short, the players are here to make profit on the other side. So ultimately, they create the market sentiment and act against the traders. So when the traders have committed the position, so that we need to understand it's a man-made market and they are all moves induced by the big players and it is not automatic or it is not a natural process. It is not a natural calamity or something like that. It is an artificial calamity created in the market in order to trigger the fear of the traders, nothing more than that. And they know very well that when they drop very quickly and when they rise very quickly, not many traders will be doing a courageous trading of sell after the rise or a buy after the drop. They know very well the human weakness and also the usable margins of the traders would invariably prevent them doing this sort of trade. But they are all wise trades, but it will prevent them. And also, you'll find that when the market is dropping drastically, somebody is buying it. Only then the trades get executed and nobody questions or nobody think about who is there enough to buy here and similarly who is there enough to sell at the highest level. So nobody questions those things. We only think about ourselves and we only worry about our equity. So we are not able to envisage or assess the strengths and weaknesses of the opponent who is trying to play against us. So in the result, we only think about our weakness, we only think about our limitations. We fail to recognize the limitations of the opponent, also fail to recognize the weaknesses of the opponent. As a result, it becomes very difficult for us to become a successful trader. And you might be thinking that why this man is talking like this? It is a very easy thing. Why not we do sell and buy trades here? Yes, we can do that. We can do either way trades. There is no problem. But not sell near the low or buy near that of the high. So after the gaining, in the case of euro, once the high is cut and if we try to do a breakout trade, they are going to trap you. And similarly, after the drop below that of the low, if you try to take a breakout trade of sell below that of the low, and they could try to trap. Because this sort of moves, they will try to do it and suddenly create the market euphoria on the opposite side by telling so many other stories and also attributes. And frequently that will be relayed through the media as well as through the websites. Then automatically all were turned bearish in euro and other majors would suddenly become bullish, but that might become too late for them to enter into the market. So the players try to enter into the market at the lowest level, drop it and induce the traders to sell and buy it at the lowest level like a hot cake. And then we will be thinking that it is falling knife, but they are buying it like a hot cake and they are buying at the lowest and the cheapest level possible and then quickly gain the levels when you think that okay, market has recovered, the bullishness has started or a bullish correction is there, there could be further 100 pips rise or 200 pips rise and why not we take a buy and sell trade at that time? They just trap us on the other side as well. So we need to read their intentions from time to time. And you might have noticed that last week I was trying to give that explanation. Either way trading opportunities prevail in the market and during the rise one can take the sell position if the new high has not been breached for more than 30 minutes and try to keep stop at entry and try to capitalize the profit during the drop. And US session I was expecting an upward spike but they have done the opposite downward spike on Friday. Yeah, I'm sorry about it and I was envisaging a upward move based on the type of market moves but it has went wrong because obviously the players are much more smarter than me and they have smelt that the traders are holding long positions and they had shown the other way for them to book loss. So by showing the newer level below that of 1.20, they are triggered and they attracted all the newspapers to talk about euro at 1.19 area. And all the magazines, everywhere you come across that the talk is only about euro around 1.19. So this sort of extreme moves are short-lived. We know very well in the past history we have seen that multi-year highs and multi-year lows have been shown, but the market has not sustained in those levels forever, and they are just reversed from there. And it's a question of time of reverse. But you might be questioning me or asking me, you have been talking about the reversal, whereas it has been dropping. When you look into that larger time frame channel, then obviously it will appear as if it is a continuous drop. And they have gained the levels on certain occasions. Or many of the weeks we have seen that they have gained the levels and then subsequently made them drop. But we should be able to identify whether those gains are sustainable, and accordingly we have to book profit. That is what I was telling you, even the previous webinar, even much before that, that market only gives a swing trade opportunity, not position trade opportunity, especially during that of the month end and month beginning. Now we are in the second week. So week beginning false move could be seen. So we will be able to understand whether the downward move is a false move or an upward move is a false move from this particular week. And there are, again, we come across 2 more weeks to go, and the third week also, partial third week, about 3 days in the next week, fifth week. So we could come across the players trying to act against the market sentiment. So with regard to the initial highs and the lows set for today, during the start of the Japanese session, they formed the low 1.187. Still it has not been breached. The high is 1.1965. That is also not been breached. Market is staying comfortably around that of the middle level, 1.1928 and 31 level. In GBP, they formed the low 1.4402. That has not been breached, and it has breached the high 1.4448 was the high, and they have breached and formed the high 1.4456. Then are they fools to buy at a higher level? We have to question. So are they here just to deceive the traders all the time? No, they are here to make money. But if they want to make money, obviously they have to cheat somebody. So that is why they make a false move and subsequently make their intentional move. And we only worry about the false move and we fail to identify that intention. So already in the case of GBP, the negative net change has turned into a positive net change. So if they sustain near here for some more time, then you could see further gains in the case of GBP. Then in the case of USD CHF 1.1618, which is intact. The market is currently trading around 1.1633 and 1.1670 was the initial high, and they formed a new high 1.1672 and then subsequently made the drop. So now you find the next change is 15 pips. When Euro has made about 33 pips negative net change, CHF is showing only 15 pips positive net change. So you can understand CHF has not gained that much corresponding to the Euro drop because they want to hold it at a lower level and then subsequently gain the levels. That is why they cut the high and go above, then subsequently gain the levels in the case of Euro and GBP as well. Similarly, in the case of USD Yen, 91.00 is the low which has not been breached from the start of the session, and 91.31 is the low, 92.12 is the high. So net change is 58 pips negative, and currently USD Yen is trading around 91.70. So you find that they are not breached the low, and they may make a small dip towards close the Japanese session, and you can watch how exactly they are handling the lows in all these currencies, and then subsequently you can try to take positions. Don't try to take a buy position in GBP near that above that of the high, because it could be a trap also, or just create the bullish feel as if the market is going to recover, and then subsequently during the European session they could make further drop and then rise. So easily they don't give profit to the buy and sell traders as well as sell and buy traders. So see how exactly they are handling the low during that of the early European session, then subsequently take the buy position. Still, our reading can go wrong at any given time in the market because we only think about our reading and our position, whereas the players think about the positions of all traders and their trades as well. Two-third volume of the market is of the players and only one-third volume of the market is of the traders. So obviously you can understand that they do the circular trades and they continue to hold the buy positions as well as sell different levels, and they only think about booking profit in the averages, not the individual positions. If you become a big player, you will also think in that level of booking profit above the average or below the average with regard to the buy positions or with regard to the sell positions. That sort of trades they try to do it, and they don't track the individual trades, and they try to accumulate and try to make swings, up and down moves of 10 to 15 pips, and that swing are mainly to keep the momentum in the market and then subsequently expose the intentions. So players cannot keep their intentions as a hidden agenda all the time, and they have to expose it in the market by making the moves. Then we can easily identify whether it is a false move or the intentional move, accordingly influence the market. Then Australian dollar 0.90809, which is also intact, and which is again to 0.8159, so about 50 pips or 50 to 60 pips, and the high is 0.8226, that is Friday close level, and from there they dropped it, and Friday close even lower they opened and then further dropped, and subsequently they are gaining the level, and they are expected to gain the levels. They are not cut the low. Slowly they are expected to gain the levels in case of Australia dollar. And you can easily understand how already when Australian dollar was considered as the strongest currency, many people were relating to that of gold and say that when gold is very strong, obviously Australian dollar has to be the strongest currency. But it looks very weak now when gold is strong. This is how they just make the market appear they are all comparable, but they are all coincidences. That is what I used to explain. And on Friday, when I read most of the reviews and the reports about what had happened on Friday and things like that after the non-farm payroll, and many of the websites and the media channels expressed that non-farm payroll was less than expected. So, because of the negative sentiment, they dropped Dow Jones. So obviously, when US economy is not doing very well, they are expected to gain the levels in the case of Euro and GBP. They dropped Euro and GBP as well, and the stock market, commodity market, only gold was gaining. All other commodities they had dropped. So in some place they said that it is risk aversion because of that the correction has come down, and other places the US economy is not improved, so stock market has come down. So instead of telling that it is the same data which can get two different interpretation in two different markets, they simply made it as a separate issue. And whenever needed, they will make it as a comparable issue. Then they will try to compare Dow with that of Euro and Dow with that of Yen, etc. And subsequently, when they are non-comparable, they will treat it as isolated issues. So, if you get convinced with that sort of interpretation, and market is going to have continuously such interpretations from time to time, then USD CAD 1.0599 is the low, which is intact. 1.0677 is the high, which is also intact, and they are currently holding around that of 1.0625, and it is in the middle level. So you can understand the market has undergone a severe stress on Friday and subsequently further drop, which has made every trader cautious not to enter into the market in a hurry. So you find the players are just making small swings without breaching the high and the low in most of the currencies, and they want the volume to pick up. Then subsequently they will just invite the European traders also to go in for a lower level of liquidation and then subsequently gain the levels. So normally you come across this sort of sentiments prevail for about 2 sessions like a hat trick. They don't do hat trick, and only 2 sessions they do it, and subsequently the third session they reverse the market. Just make it appear as if it is going to have a continuation and just reverse the market. And if you compare it to that of the levels, it will look very bearish. But when you compare it to that of the gains and the drops with regard to the net change and the tradable opportunities in the market, you will be able to understand that the previous levels are not going to help us really whether we can do a buy and sell trade or a sell and buy trade. Say for example, if I buy it at 1.1877 and book profit at 1.1960 or 65, still it is a profitable trade. Similarly, if I sell it at 1.1965, it is not breached and try to buy it near that of 1.1877, it's a profitable trade. So ultimately, we have to think of the profitable trade rather than worrying about the respective currencies. So let me minimize the PowerPoint presentation and take up the questions which are asked here. And meanwhile, focus the camera over that of the live market quote page. Okay, new it has got a question. Is not sell on rallies in line with your sell at high and buy at lows, or sell on rise and buy on drop? Yes, you can do that. But no, I just made a remark in the blog that how out of fear such statements are made. Nothing more than that. See, if you are able to read the market clearly, market continues to give buy and sell opportunity as well as sell and buy opportunity. So, if there is a buy and sell opportunity, without any fear, we should be able to do it. How we can do it? If you use the specific strategy of buy, and if the position starts making profit, keep stop at entry and eliminate the risk. Then a buy and sell trade will be profitable. Then similarly, after the rally, if you try to sell, fine. Near that of the high, you can sell, definitely. And we have to use the trading strategy of trying to keep stop at entry to limit the risk, or use the hedging order to limit the risk. And that is also equally important rather than simply telling that sell on rally. No, it is an emotional statement, simply sell on rally. At what level, if anybody questions, then we have to find out at what level you can sell. Okay, near the high, or when the high is breached and the new high has not been formed for more than 30 minutes, or continuously they rise about 150 pips or 180 pips. Can we take a sell? And we have to determine that. That sort of determining ability is needed rather than simply telling sell on rally. That is what I made the remark, because I want everybody to objectively think about the market. So I always recommend a trade along with the other players, because it is extremely difficult to trade against the player, but trade along with them. So what they are trying to do is, they drop the market and buy, they rise the market and sell. That is why we have to find out when they are stopping the drop. When they stop cutting the low in a particular session for more than 30 minutes, that means they have stopped dropping it and they are trying to accumulate when the traders started selling. Then at that time, after 30 minutes, they can buy, so that we will be able to easily keep stop at entry. That is the first step. And I am not telling that it is going to be a 100% successful trade. We should be able to keep stop at entry. That means no risk trade we are taking. If it is stopped out, then we lose the position, but if we don't lose our equity. So that sort of trading decisions are very essential, rather than simply becoming emotional and euro is very bearish and you just try to sell. And if you develop the mindset, when they gain the levels, it's extremely difficult for us to change our mindset. And by the time we change our mindset, the market would have changed the trend. Then Arun, do you see GBP coming close to that of the low in the Japanese session? Yeah, there is a likelihood that GBP could come, because they made an upward stop, and as I explained that I told you, don't buy just because they breached the high and they come below that of the 1.8 and now trading around 1.4432. So this is how they just make up and down moves. We need to understand that. And during the mid sessions, avoid taking position. Either during start of the session, around 4402, you would have taken a position. You could have earned about 30-40 pips. Then subsequently they made an upward stop and wait for the session close. So session close or the late session is from 6 to I mean 5:30 to 7 GMT. So now it is 5:30. We just see how exactly they are doing it towards close of the session. Otherwise, you can wait for the gap time and see what sort of gap time moves they are making. Or wait for 30 minutes of the session start. Then see how they are. When they come closer to that of the low or closer to that of the high, you just review the market. Rather than when they are staying and taking rest in the middle level. That means low volume prevails in the market. That is why they keep the market in the middle level with nominal swings of 5 to 10 pips. So during the drop, you just see where exactly you can fly G to B. Because it's extremely difficult to determine up to what level they could drop or what level they could gain. It depends upon the volume. So we don't have access to that other volume, but still we can identify this is the low when the low has not been breached for more than 30 minutes. And if they cut the low and stayed below that of the low for more than 30 minutes, understand that they wanted to drop till 2 hours. So wait calmly for 2 hours and see how exactly they are handling the new low. Then try to do a buy and sell trade. And definitely you should be able to keep stop at entry if you buy it like that. On Friday also, they dropped it to 1.1967 in the case of Euro and then subsequently made the pullback. You are given an opportunity to keep stop at entry. And if the position is stopped out, you don't lose anything. And again this morning, you just during the Japanese session, you can see that what low they set, how exactly they handle the market near that of the low. And accordingly, take the buy position. I'm not telling you just become bullish when the market is dropping and trying to take a buy position. Or just become bearish when the market is gaining the levels, taking simply sell position. So, I don't recommend sell on rally or sell or buy on drops. I only recommend to sell near that of the high when the high is not being breached for more than 30 minutes or buy near that of the low when the low is not being breached for 30 minutes. So there is a difference between that, please. So I am only giving with regard to the identify the evidences available in the market and then try to commit rather than becoming an emotional trader, then bank a player. When everyone is thinking of selling now, it will go up as weak beneath falls move. Is it correct with Aussie? Yeah, that is possible. If everybody is willing to sell on rally, then definitely the rally could be a continuous rally. We need to see that. Yeah, Aussie could lead the rally. We have to wait and see. Or at times they may use some other currency to start with. Either Japanese yen or GBP could also be used for that. And they can simply change the market sentiment. Then yeah, so what are your thoughts with regard to USD as we are going to 89.90 again, or do you see 92? Now I am envisaging only 92-93 area in the case of USD. And when you see carefully, when you watch the behavior in the case of yen, you know that they give the pullback. On Friday, they made a quick do in the case of USD and gone above. So they came down to that level of 91.43 and then went up to 91.83. Then they have not gone above that of the initial low, 91.91. Then subsequently this morning they went for an upward stop into 92.12 above that of the initial low. Then subsequently dropped to 91 and holding near that of the low. And they know very well that traders are not here willing to take sell and buy trade or a buy and sell trade. That is why it is hovering around the same 91.30 to 91.15 area for about 5 hours. Otherwise, if they want to really create panicness or if they want to really drop USD yen, telling that it is a safe and haven currency, then they would have already dropped about 100, 150 pips there. And the correction is about 67 pips in the case of USD And once they identify some stops below that of 91, they may breach that area and then go up. And if they don't find stops, instead already the traders have liquidated the long position. And in order to maintain the euro sentiment, they may not rise USD in case if they want to maintain euro sentiment. Okay. Otherwise, if they want to change the sentiment, they could gain the levels in the case of USD because they are doing contrarian move. First, they will gain the levels in the case of USD and that can be identified, but when the net change becomes closer and closer to that of 0. When it, see now it is hovering around 68 pips. So when it becomes 55 pips or 40 pips, 30 pips, that means they are slowly gaining the level. After coming to 0, how they are doing it. And when they reach the positive zone, like plus 2 pips or plus 5 pips and things like that, if they sustain for more than 30 minutes, then quick gains will come in the case of USD. Otherwise, they will try to hover around in the negative range, and you know that for more than 2 sessions, they don't continue the same sentiment, and during the year session, they could gain the levels. So, see how far they are doing the downward stop in the case of USD, it might be about 10 to 15 pips if needed. Otherwise, if they would have already stopped out of the stock and they are willing to buy it at these levels, then they may not, and the traders are willing to short here. Because in relation to that of the euro yen position, suppose somebody has got a buy position in euro yen and they could do a sell position in USD yen as a hedging. And if somebody have taken already, or predominant of the traders have already taken the sell position, they will gain the levels in the USD yen as well as euro and trap in the hedging as well as in the original position. So I'm expecting USD to go above 92 today. That's my expectation. It can be correct or it can go wrong. There is an element of error in every analysis, and so one need to understand there is an element of risk in every type of analysis, and we have to use the appropriate trading strategies to limit such risk. And Jimbo, if euro rises and stays above the low today, do you see the possibility of a good position trade? No, I'm not envisaging any position trade, Jimbo, now, because the players are now trying to accumulate the buy position. So in order to accumulate the buy position, what they do is they make a swing for about 300 pips, 400 pips and things like that, and quickly book profit with regard to their buy position, again drop and show a new level so that traders will sell, then again gain the level and show a little lower high. Then immediately you will find that traders started taking sell positions after the rise, okay, using the technicals. When the traders are not willing to buy when the players sell at the higher level, and the traders also sell at a higher level along with that of the players, then quickly players turn and buy all the sells and gain the level. So that situation has to come. So still herd of traders find that, okay, I am willing to do a sell and buy trade. In case if there is a pullback, I want to just cut and turn long. That sort of strategy is being used by predominant of the traders, and that is why you find more of a swing, wide range swings are happening in the market rather than a trending move. Then balance. Is it time to buy Euro GBP? So Euro GBP, you know that Euro is showing a negative net change of 44 pips. GBP is showing a negative net change of 19 pips. So you find Euro is dropping more when compared to that of GBP. So they could go to that of level of they already set the low of 0.8242. They could breach the level, and the high is also 0.8286, and net change is 17 pips. And during the European session, they could breach the level and show briefly the level of 0.81 and see how the new low is being handled. When the new low has not been breached during the mid-European session, then you can initiate a buy position. That is why I always tell you, don't focus only on the level, focus on the timing and focus how exactly the players are handling the low. And if it's statistically derived, you might come across a support. The market may not go up to the support and then reverse. And it can just reverse before that. And you may miss that opportunity if you look into that of the level. Because we know very well market need not respect our supports and resistance calculated. They knew it. You said players have smelt that there are long holders, and you also say that traders take sell near the lows. No, no, no. When the traders have taken the buy positions at a higher level during the rise, and the players were selling to them, and the traders were freely buying it at 1.24 or 1.25, then they are not liquidating or stopping it out, those positions with 30-50 pips. Instead, they are trying to hold it with a large stops, like 100-150 pips stop. Then, which is the better way of earning money for the players? If they drop, they can earn straight away 150 pip stops or 200 pip stops, rather than rising and giving profit to those long holders. So this is how they estimate. Then what happens when they are dropped and hit the stops and buy at the lower level? The traders, in order to earn back the loss, they quickly turn long or turn short at a lower level with a bearish feel. That's what I referred. So buying it after the rise, selling it after the drop, it is something like trying to enter after the event. The euphoric event is over, then people will realize, no, it is stupid idea of selling it around 1.19 in the case of euro or 1.18 in the case of euro. When people have realized, then you will be still holding the buy sell position at those levels. So do not do such trades. That's what I said. Hope you are able to understand. In Jimbo, history has shown that when we get extreme moves like the euro drop, the opposite move has also been quite big here. Do you see any reason why the current situation will be any different? The current situation is not different. Only thing is lesser volume when compared to that of the previous years. So it is taking a longer time for them to bring in trend reversals so quickly. And also, when they reverse, immediately traders also reverse the trade. And the traders doing the averaging trading. So suppose somebody has taken a sell at 1.20 and market went up to 1.24 and taking averaging sell. If they continue to do the averaging sell, then the players can rise it up to 1.28 in order to induce them to do the short covering. Whereas what happens when they rise from 1.22 to 1.24, a short seller close the short or cover the short and turn long. And similarly, when they drop, a long holder liquidates long and turn short at lower level. So immediately when they change the direction of trade, obviously the players are not in a position to make the trending move. If you look into the bigger channel, it will appear as if the market is going at a trending line up a downward move. But if you see the intraday moves, etc., this is the whole scenario. The traders try to confuse themselves and try to do buy and sell trade as well as sell and buy trade. And instead, if they could understand the daily limitations and weekly limitations and then try to do a buy or a sell, then their traders will become wise traders. And because the players need emotional traders, only then they will be able to earn. If all turns to be wise traders, then it becomes very difficult for the players to earn money from the other market. So, as long as the traders are emotional, what they do, they quickly commit the positions. After losing money, they keep away from the market. Then, if everything settles down and they find, okay, there is a chance for euro to rise, then later on they enter into the other market. So there are two categories. One, they try to earn from the buy position. If the buy is not making profit quickly, they turn sell. They turn a seller, and if they lose there, then they keep away from the other market. And they say that this market is no good, and they start yelling at the market interpretation. See, last non-farm payroll I compared that inventory was positive, then euro and GBP went up. This time non-farm payroll is negative and USD has still again gained, and this sort of interpretation they will try to give and say think that they are wiser analysts, but they fail to realize that they are not good traders. Then maybe a few more days before it can rise Euro and GBP. Yeah, Euro and GBP. See, obviously, what the market can offer, either a rise or a drop on a daily basis. You know? The levels keep changing. At one point of time, we feel like selling at 1.19, and another point of time, we feel buying at 1.24. So that is our perception. So the players continue to show various levels so that we get confused with our market perception. We don't read the true intentions of the players. So that is why they continue to show the levels, and it is not the world has come to an end, thereby all the currencies have collapsed and the US dollar alone has gained. Okay, fine. If US dollar is the only currency which has to gain, fine. After gaining and after converting all the currencies into US dollar, that US dollar currency notes will not multiply. Only if it is invested elsewhere, it can multiply. So where they are going to invest? So if you question all those things, then you will be able to reason out what they are given in the form of attributes in the market or simply hypes. Then Francisco. Sell and buy trade can also be profitable if one is able to take the low but catching short-term tops is still much easier in this market. Yes, you can develop the trading ideas depending upon the market moves. I am not telling that you have to do only buy and sell trade on a daily basis. I only recommend that try to aim to do swing trades. So, if you find there is a gain potential of about 30 to 50 pips or 70 pips, do a buy and sell trade. If there is a drop potential of 50 to 70 pips, then try to do a sell and buy trade and use the trading strategy to maximize the profit by trailing the stop as well as moving away the limit from that of the market. If the going is good, try to maximize the maximum profit. Still, it is not a position trade. A position trade is the one wherein you will enter into the market and end of the month you will be able to convert it. And that sort of position trade can be easily done with it of the futures and the options market. But that situation has not come in now. Anyway, when Euro USD dropped from 1.60 to 1.23, lost 3,700 pips from mid-July to end October 2008, you said it was a multi-year trend reversal and such moves are not seen often thereafter. Yes, you called it multi-year because such highs have been shown in multi-years. So 1.60 in the Euro was not shown many times. Similarly, in the case of GBP, 2.11 was not shown many times. Then they are referred as multi-year highs. And similarly, the multi-year lows like 1.34 in the case of GBP. Now, Euro has lost about 3,200 pips from 1.51. No, you are mistaken. So, the year-end closing was around 1.42. From there, Euro has dropped. And for this particular year, if you try to compare it with that of the season high and the season low, you will only become panic and you will become really worried. It has dropped about 3,200 pips, but that is not true. And to 1.18 now, November 2009 until now. As you say, levels are not important. So in terms of percentage, Euro has lost 23 to 22 in those periods. What is the current move called? Okay. Now, when you look into that of the long term, obviously it will look like a downward trend. I explained it. It will look like a downward trend. And I was also giving the call during the early January that Euro can drop up to 1.37 and then reverse. So I never said that it will just straight away rise from that of January. During January, I was expecting the drop, but subsequently the drop has happened more than that of the expected level. They are all estimated level. Beyond that, they have come to about 1.32. Then subsequently, it was expected to gain. Instead, it has dropped further, nominally to 1.28. Then again, it went up to 1.28 and then it dropped. So every time it has gained some and dropped, gained some and dropped. And in that process, the gaining you find it is less significant, the drop you find it more significant because you compare it with that of the highest level to the current low. And all the gains happened intermediary, you simply tend to call it as corrections. So when you become biased in our estimate, you'd have seen that the moves where if you draw the channel from 1.51 and the low set at that particular time and draw down the channels, you will find the difference between the high and the low will be about 1200 pips. When you go in for a wider and wider channel, it will cover the entire market and it will appear the market is going down. You try to estimate it. You try to take the high which was set during 1989 and then try to draw the channel. You will find still market is coming down. So if you take the percentage in relative terms, from that of the high, that drop has happened. And if that is the case, then when euro was introduced as a as a tradable currency, not a executable currency, and it was trading around 1.47, and from there it dropped to 0.78. Then from there it gained all the way. So when you draw the channels from those levels, start of euro, or if you go before that, okay, how was the Deutschmark behaving, and you just make a currency conversion there and try to draw the chart. And you can continue to estimate that way. But whether that particular estimate is helping you to do a daily swing trade, if it helps, fine, I'm happy about it. Then drop. Will the drop majors further or will rise from here? Close of the Japanese and start of European session. When I explained that start of European session, they are expected to make a drop and then subsequently gain. So the drop will indicate how much of panicness they wanted to create in the market. If they are not dropping during the early European session, understand that traders have already taken sell positions. Don't try to add more sells to the market. When somebody is buying it, keep it in mind. When we are all doing selling or buying, somebody is acting against us. Keep that in mind and act accordingly. Then Caesar, your input on gold. Gold is expected to drop. They gained the level to that of 1220 and they are expected to drop it again, gold. And they are slowly building sell positions in gold now, and that money is being pumped into the currency market. That is why they sustain the levels. See, similar to sustaining the levels in the case of euro 1.60. They are sustaining the levels at around 1,200 in gold, and they are building sell positions. We will realize it later, but at the moment it will look very bullish. That is why I always say what appears is not true in the market. Then Jason, what is your view on Australian dollar? Is it correct that Aussie is rising after Friday and early morning down stock? No, as far as Australian dollar is concerned, 0.80, one can initiate the buy. Whenever there is a drip, one can initiate a buy. Still, to limit the risk, one has to keep the hedging order of 40-50 pips. If it is hedged, try to keep stop at entry and calmly wait. They will be reversing the market very quickly and then hit the stops at the hedging and continue to gain again. Then you keep the hedging order or try to keep stop at entry once the buy position makes profit. And that sort of trading strategy one can use, and it's really a bottom fishing level, but people will not agree to that. Our mindset will not agree to that. Then grow. How do you see that indices this week? I'm expecting the stock market to gain some levels till midweek and then subsequently drop again. Then Arun. Suppose if they show 1.40 in GBP, then do we expect that will go below more than 1.35 because there will be a lot of buys at 1.40 area and 1.35. Could it be the final low for the year? See, if you try to estimate it that way, that at every drop people are willing to buy, so that the players have to forcibly drop it further down and hit their stops and then subsequently gain the level. And there is also a factor called the interference factor. The respective countries, the majors belong to the respective countries. They also see that how far it affects their trading, how far it affects their valuation. If the valuation goes beyond the intrinsic value, and they come in for the intervention, because it also start affecting their economy verbally. So obviously they will not make such extreme moves. If that is the case, they can even take GBP to below parity and euro to below parity, and they can make the US dollar the richest currency in the world. They cannot do that way simply, and they have to make the oscillations. If that is the case, then you know that I can cite a typical example. After the 9/11, US dollar US dollar lost nearly about 300 to 350 pips against euro and GBP, about 500 pips in the case of in the case of GBP on September 11th. And you know that subsequent day, the same amount of drop happened in euro and GBP in the name of interference from that of the US government. Fact. So I remember still about $87 billion were used in order to make the market to come back to the same level. But subsequently the market did not sustain those levels and it has gone above. And from there euro gone above the parity, etc. So that's a long story. So obviously extreme levels are not being sustained for a longer time in the market, and there is no necessity for the players to show again and again extreme levels for the traders to sell. And when they drop 3-4 times, then the traders either keep away from that market. And if the traders keep away from the market without a volume, the players will not be able to make any swing and take any advantage from the market. So obviously they have to necessarily gain the levels in order to get back the traders into the market. There are so much strategies involved in the market in order to attract the traders to start with, then subsequently induce the traders to commit, and then earn the money from the trade. So these are all the tasks of the players. So they don't do such extreme moves all the time. Only we imagine drawing from that of November 2009 or even from that of 2008 multi-year highs and draw the lines and say, we can draw the line even from 1.62 and say that euro has dropped such, and it will only trigger our fear. But it took such a long time for euro to drop. We don't realize it, and we are not going to hold the trade for such a long time. So traders need to think like a trader, not like economists. Do you see USD and euro equities dropping further today? Yeah, there could be a further drop to start with, but US session, there could be initial drop and then a reversal, I'm expecting, in US stock market. Then Harry, can you explain market daily cycle? See, market daily cycle, there are 3 sessions in the market. So not more than 2 sessions they continue the sentiment. The third session they reverse the sentiment. And the market cycle is every 2 sessions. It is not on a daily basis. It is on every 2 sessions. If you continue to estimate the 2 sessions, you will be able to identify, okay, what exactly they are doing it. So there is no need to watch all the 3 sessions in the market. If you are capable of watching 2 sessions in the market, the players keep showing the levels, and we will get the trading opportunity. We are not going to miss the trading opportunity. So that is how the market works. And similarly, 2 days a similar cycle, and the third day a reversal. Then banker. Okay. For euro and GBP, what would be the good level to buy with hedging? Any level is good. Near the low, 1.1877 if they come to, and if they don't breach it, then you can, for 30 minutes, then you can take a buy near that. In case if they make a downward stop and quickly gain above that of 1.1877, stay above there for more than 30 minutes, you can take a buy around 1.1877. Or if you are willing to take risk during such stop, when they formed a new low and that is not being breached for 10 to 30 minutes, you can take a buy there. And once they go above that of the high, quickly keep stop at entry that could be a good buy. So this is how the buy levels are to be estimated rather than using the statistics, using various simple moving average, because we trade in the current market, not based on the past market. If the stock market drop midweek, will that not be a drop in euro? See, you need to understand, sir. Now you have seen that gold has gone up, whereas Australian dollar has come down. In a similar way, when stock market is dropping, they could probably relate it to that of Japanese yen and say that Japanese yen has dropped, instead euro has gained, and they can show any sort of relationship. And when stock market is dropping, they can say that money is coming into that of the currency market, so currency market has gone up. So no relationship, and it is a contrarian relationship. So the correlations can be a direct correlation or inverse correlation from time to time. So there is no static correlation. So if that is the case, then try to avoid correlating the market. You read the current market, or you read the market in which you are interested, and read the other market and see how exactly the market is creating the market sentiment. Then focus on the currency in which you wanted to trade. Okay, Jason. When are we used to our rule? Whenever they cut the low and stay below that of the low for 30 minutes, then another 1 hour and 30 minutes wait. Whenever they cut the high and stay above that high for more than 30 minutes, then apply the rule of 2 hours. Wait another 1 hour and 30 minutes. Then afterwards take a sell position. You will be able to see profit in such trades. I have taken much time. I'll focus the camera out of the PowerPoint presentation again. So expected market move, higher level swing and the slide and the drop during the early European session and firming up move. And this drop will indicate how far the bearish sentiment they wanted to continue. And don't simply refer the level 1.19 and become bearish. And they are all tradable levels. Only you have to identify whether you can do a buy and sell trade or a sell and buy trade. And the drop during early European session will indicate whether you can do a buy and sell trade or wait for further drop. Then US session they will do the lower level swing and firm up, and they could go above that of Friday close level during that time. Then it will confirm that it is a weak beginning false move, and tomorrow again during the Japanese session they are expected to make an unexpected downward stop and then gain the levels. Be prepared and do only swing trade when you are entering into the buy and sell trade, and try to book profit. Tomorrow after the drop you can take a buy position again. Sell and buy trade you can do it provided you are able to watch during the day transition. After about 21:30 GMT, you can watch and take a sell position in Euro and GBP. Then next Japanese session drop, you can book profit. But not many traders in different parts of the world may be able to participate in that particular Honolulu time frame. Okay, so I take this opportunity to thank everybody who have come here to listen to my webinar, and is being recorded and it will be displayed in the FX my blog market reading. You can listen to it in case you have not attended it fully, or in case you are not able to understand it fully. You can ask questions there. I am willing to answer the questions, and my main effort is make you to understand how the market functions, how exactly you can take trading decisions and not the simple forecast.